Module Overview to equip agribusiness owners, farm managers, and aspiring agri-entrepreneurs with comprehensive knowledge and practical skills to access, manage, and effectively utilize credit and loans. This module emphasizes the principles, types, sources, processes, risks, and repayment strategies of agricultural credit, all tailored to the unique financial dynamics of agribusiness ventures. Introduction to agricultural credit. Agricultural credit refers to the provision of financial resources to farmers or agribusiness operators to enable them to start, maintain, or expand their enterprises. Unlike conventional credit, agricultural credit accounts for seasonal income, production cycles, and weather-dependent risks that characterize agricultural operations. Credit is often the lifeblood of agribusiness, especially for smallholders or startups lacking adequate capital. However, improper credit usage, poor loan management, and unfavorable loan terms can lead to debt cycles, business collapse, or even land loss. Why credit is important in agribusiness. 1. Capital acquisition to purchase land, machinery, seeds, fertilizers, livestock, or technology. 2. Bridge seasonal gaps helps farmers survive between planting and harvesting seasons when income is low. 3. Enable growth and expansion, funds used to scale operations, diversify crops, or access export markets. 4. Mitigate risks. Credit can serve as emergency capital during adverse events like drought or disease outbreaks. 5. Promote technological adoption. Use of improved seeds, irrigation, and mechanization is often credit-driven. Second, sources of agricultural credit. First, formal credit sources. These include licensed and regulated financial institutions with structured lending policies and legal compliance. A. Commercial banks offer various loan products with interest, collateral requirements, and documentation. B. Microfinance banks target small-scale farmers with simplified lending procedures. Development banks, such as Bank of Agriculture, BOA, or Nigerian Agricultural Bank, created to support rural development. D. Cooperatives and credit unions, member-based systems that pool savings and offer loans at lower interest. E. Government schemes, e.g., Anchor Borrowers Program, NERSAL loans, or CBN agri-credit initiatives. 2. Informal credit sources. These operate outside formal regulation, often in rural communities. A. Family and friends, based on trust, often interest-free. B. Moneylenders, quick access, but often high interest rates. C. Trade credit. Suppliers give inputs, seeds, fertilizer, with delayed payment after harvest. Third, digital and fintech platforms. Modern agritech apps and platforms now provide mobile loans, crowdfunding, or peer-to-peer lending with quicker approval and less bureaucracy. Third, types of agricultural loans. 1. Short-term loans. A. Repayment within 1 year. But B. Used for operational costs. Seeds, fertilizer, wages, pesticides. Second, medium term loans. A. Repayment within 1 to 5 years. B. Used for livestock purchase, irrigation equipment, fencing. 3. Long-term loans. A. Repayment beyond 5 years. B. Used for purchasing land, buildings, tractors, or processing equipment. 4. Working capital loans. A. For daily running expenses and cash flow management. 5. Asset financing. A. Loans tied to the acquisition of physical assets, machinery, greenhouses, etc. 4th, creditworthiness and loan approval process. Before granting a loan, institutions assess the borrower's creditworthiness using the 5 C's model. A. Character, reliability, and honesty of the borrower. B. Capacity, ability to repay based on income or farm output. C. Capital, net worth or assets that indicate financial strength. D. Collateral, assets that can be used as security in case of default. E. Conditions, purpose of the loan and prevailing economic conditions. Borrowers must present 1. Business plan. 2. Farm records. 3. Proof of land ownership or lease. 4. Government-issued ID 5. Financial statements if available. V. Loan utilization and management. Many agribusinesses fail not because of loan access, but poor loan utilization. Effective loan management involves A. Allocating funds to planned areas, not personal use. B. Prioritizing high-return investments, e.g., irrigation, inputs. C. Keeping records of how loan was spent. D. Avoiding multiple concurrent loans that create repayment pressure. E. Using insurance to protect financed assets. Sixth, loan repayment and monitoring. Loan repayment is a critical responsibility, with consequences for default including loss of collateral, bad credit history, and legal action. Repayment methods. 1. Lump sum, full repayment at end of the term. 2. Installments, monthly, quarterly, or seasonal. 3. In-kind, sometimes allowed, e.g., part of harvest instead of cash. Monitoring tips. 1. Use calendars or reminders. 2. Set aside savings during surplus seasons. 3. Communicate with lenders if challenges arise. 7th. Common challenges in agricultural credit use. A. High interest rates, especially in informal sectors. B. Complex documentation for formal credit. C. Lack of collateral, especially for smallholders. D. Mismanagement or misuse of funds. E. Unpredictable risks, weather, pests, affecting repayment. F. Illiteracy and poor record keeping. Best practices for agribusiness loan management are always match loan duration with the income cycle of your agribusiness. Avoid overborrowing, only take what you need and can repay. C. Invest borrowed funds in productive assets or ventures. D. Maintain good financial records and budget loan usage. E. Seek financial literacy training before borrowing. Diversify income streams to aid repayment.